and the live stream is up. Are we waiting for Kathy?
She did say she was going to be here.
Hey, Greg.
Good morning, Doug. Good morning, Heather.
Good morning.
How are you guys?
Good, how are you?
Good.
Good. You want her to, Sharon, can Carrie read the statement, open it up?
Sure.
Are we live, Carrie?
We are live.
Okay.
Good morning. This is the public session of the Holmdel Township Committee meeting scheduled for June 15th, 2021 at 9:30 a.m. This meeting is being conducted on a remote electronic basis using Zoom with live streaming on Facebook and YouTube. In accordance with the Open Public Meetings Act, NJSA 10:4-10, and the regulations governing the remote meetings, NJAC 5:39-1.5, I hereby announce that adequate notice and electronic notice of this meeting was provided in a notice dating June 10th, 2021, that was sent to the Asbury Park Press, Two River Times, posted on the bulletin board and on the main access door to Township Hall, filed in the clerk's office, and posted on the Township website, www.holmdeltownship.com. Please be advised that the agenda for today's meeting is also available for download on the Township website. Members of the public wishing to provide comment at the designated times may do so over the Zoom platform by clicking the raise hand button or by dialing *9 if accessing the meeting via telephone. Public commenters are asked to provide their name and address prior to the comment and shall be limited to 3 minutes. Public comments may not include disruptive behavior or conduct such as profanity. Public commenters are reminded that this meeting is being live streamed over the internet, will be archived on the Township's YouTube and Facebook pages, and that recordings of the public meeting are public records subject to the Open Public Records Act. Mayor Bontempo?
Here.
Ms. Weber? Not here. Mr. Critelli?
Here.
Mr. Lucarelli?
Here.
Mr. Santana?
Here.
Mayor, you have a quorum.
Thank you, Carrie. Everyone, please rise for the Pledge of Allegiance and then please remain standing for a moment of silence. I pledge allegiance to the flag of the United States of America, and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Please remain standing for a moment of silence on our troops both home and abroad who work tirelessly to protect us each and every day. Thank you. Sharon, I will hand off to you to give a quick overview of today's session.
Sure. Do we want to do that one resolution first? 153A? I'm sorry. Yeah, 153A. The resolution to go back to in-person meetings?
Sure. So there's only one, correct, Sharon?
Yes. Just that one resolution to go back into live in-person meetings.
2021 153A. Do you have a motion?
Motion.
Second.
Roll call, please.
Mr. Critelli?
Yes.
Mr. Lucarelli?
Yes.
Mr. Santana?
Yes.
Mayor Bontempo?
Yes.
The resolution has been approved.
Thank you.
I will see you all in a week in person.
Looking forward to that.
Yeah.
So we wanted to hold this special meeting today. At a previous Township Committee meeting, the Township Committee asked for an analysis in terms of where we are with our debt so that we can best plan capital. And we, as everyone knows, we recently just passed our municipal budget for this year. We want to move forward with our 2021 capital plan, but the Township Committee really wanted to kind of get an idea of where we are, how we compare to other municipalities, and what would be a responsible things to consider as we move forward. So we have Doug Bauscher and Heather Litzbauer here from NW Financial. They are our financial advisors. Bill and I have been working with them for the past couple of weeks to kind of go over where we are, and we just wanted to do a presentation for the Township Committee. And after that, we're happy to answer any questions that you may have. So with that, I'm going to hand it over to Heather. We do have she does have a PowerPoint presentation, and I think you should be able to share your screen. And we will get it started. Perfect.
Okay, we all ready here?
Quick question before you get started, Sharon, will this presentation be posted on our website after the?
Yes, it will be.
Okay, thank you.
And as all of our Township Committee meetings, this meeting will also be posted. So if anyone wants to go through and get the information at a later time, they're welcome to do so.
Okay, we ready to start? Thank you for having us. Again, I'm Doug Bacher and Heather Litzbauer from NW Financial. Heather and I have been doing this for a long time, and we've been a team actually for a pretty long time on mostly all of our clients, especially those clients that we have in Monmouth County. Some of you may know we are also, Heather and I, the team of financial advisors at the Monmouth County Improvement Authority. So we have a good handle on the county and municipal finances in general, having looked at so many towns over the years. We thought it would be a good idea to work with Sharon and Bill and give you a brief update about your debt position and your debt planning, and we'll just take it from there. So Heather, why don't you slide down to number 2?
Hey guys, before you kick off, Sharon, can they go to presentation mode, because I'm getting the kind of the blocks on the side?
Yeah,
So
slide 2.
Let me, let's
Heather,
see.
if you just hit the bottom right, that little.
Yeah, I was on it, and then for some reason,
If it's not working, I can do it.
it's because I have 2 screens. It's on my second screen and won't go on the Zoom screen.
Give me 1 second. I will. I'll do it. Escape.
So Greg, you can minimize, right? I just minimized my thing and then I had the full screen.
No, it's what they're sharing.
Yeah, I tried doing that. It wouldn't let me do it.
1 second. Give me a second.
Also, Carrie, there's a member of the public that seems to be on my screen as a participant. Is that something the mayors look to have? There you go. Thank you.
That was weird. Sorry about that.
It's okay.
A good catch.
Share. And we good now?
Well, that's better.
Yeah.
Yep.
Very good.
Up. Just
I'm right back.
Oh, went back?
Yeah.
I'm sorry.
Just flip back. Yeah.
That's weird. Not for me. I have the full presentation on my screen.
Wow.
Well, I minimized the column on the right where that was blocking it, and I'm good.
You guys good?
I have the whole presentation as well.
Oh, there we go.
Everybody
Yep,
good?
we're good. All
Yep.
good.
Yeah, I'm good as well.
Okay. I think we're ready.
Okay. We'll get started. There's a lot of information here. There's some general, there's some more direct information regarding your budget and your capital planning and your position. I thought it would be a good idea to try and give you a broad overview that includes general information so that everybody is at the same place as we get more into the information regarding Holmdel in particular. So we'll just start. You know, you have a capital improvement fund in your budget. That capital improvement fund, you put money in there on an annual basis, and it's where you draw down to either pay for capital projects directly or to draw down on a 5% that's required when you do a capital ordinance. Whenever you do a capital ordinance for a financing or to authorize a financing, you do need to fund it 5% upfront. You also do a 6-year capital plan that's part of your budget that's submitted to the state of New Jersey DCA. It's non-binding, but it's supposed to be a tool which you guys are using it to just help you plan as things are moving forward. That capital plan usually get changes every year, and it's a part of the budget document that gets submitted to the state of New Jersey as well.
Some municipalities don't take that budget as seriously as others. We think it's very important to do that because then you can plan how you're going to fund your capital improvements in the future. So it's a good tool to use so you know what you can issue on an annual basis and what's coming up in future years so you can start planning budgetarily for those improvements.
Right. Yeah, it is a good tool. It's a good tool. And you include things in that capital plan that would have a long useful life. Anything from 5 to 40 years is what's permitted in the law. You do land acquisition, road improvements, construction of facilities, building improvements, and equipment are just examples of the things that you're going to find in that are in your capital plan. Go ahead, Sharon, keep a flipping. When you do a capital ordinance, you adopt it, obviously. There's 2 readings. And like I said, the capital ordinance is funded in cash, at least at a 5% level through that capital improvement fund. That capital ordinance authorizes the project, whatever you're doing, or the equipment, or whatever you're going to finance, and it authorizes the issuance of debt. And it doesn't specific, not always, it doesn't always isn't specific on exactly how you're going to raise the money because you have a couple of alternatives, but it gives you the ability, the money is now authorized, it gives you the ability to begin spending on that capital ordinance. And we could get into more detail, but you typically don't fund a capital ordinance until you need the money, because obviously there's a cost associated with doing that. There's a 5% down payment, which we've talked about. The bond ordinances require 2 readings, which I just mentioned. The funding options are basically 3 things. You have bond anticipation notes. That's done for 2 reasons. One, if it's a shorter life project, you might want to consider doing notes and keeping them in notes. If it's sometimes, and most of the time, notes are gathered over a period of a couple of years, and then it's rolled into, something happened to my screen here.
So while Doug's getting his screen back up, I'll just jump in. So for bonds, that's more of a long-term plan. Typically, when municipalities first start issuing debt for a new capital project, they will either pay cash for it if it's a short useful life, or they will issue bond anticipation notes. Bond anticipation notes is a 1-year maturity. You're allowed to roll over bond anticipation notes for 10 years, and then you have to either pay them off or you have to permanently fund them into bonds. Bonds is long-term, so it's based on the useful life of the asset. Or you can you could finance a lease. That's with capital equipment, or you can do a public-private partnership. For a municipality's net debt in New Jersey, there's a law that the net debt cannot exceed 3.5% of the municipality's average equalized valuation for the last 3 years.
Heather, keep going. I still don't have my screen. I don't know what happened.
Sure. So let's talk about the township's net debt capabilities. As of this past year, Holmdel's last three average equalized valuation is just over $4.3 billion. So based on that, 3.5% of the last 3 years is $150,917,955. So if the township wanted to, that is their cap on what they can issue in debt. Your current debt ratio is 0.895%. For a total of $38,576,356. So the township has the ability to borrow an additional $112,341,599. And we're talking about maximums here. The issuance of debt affects your credit rating. So if you are at the higher end, that would negatively affect your credit rating. Right now, the township is sitting in a good position where you have done the projects that you need to get done, but your debt burden is not high.
Sorry, Heather, I still don't have a screen.
No problem. So for bond anticipation notes, we'll just go into more detail on them. They're issued for 1 year or less, which we discussed already. There's a new interest rate at each issuance of notes. So there is market risk for issuing notes because year to year, the market changes. In New Jersey, you have to start paying minimum pay downs in year 3. And that's based off of the useful life of the asset. There's a formula that determines what the minimum pay down is. It's secured by the township's ad valorem taxing power. And they can be sold either on a competitive or a negotiated basis. So typically for bond anticipation notes, especially if it's of a higher size, we'll issue that in the competitive market. Underwriters will have the ability to give their best rate possible to buy the notes. Sometimes it's good to negotiate that process. If it's a smaller note, $1 million or less, a lot of times your local bank will give you a very competitive rate. There's lower costs of issuance for doing that, and you don't have to have an offering statement. And like I said, an offering document and bond rating is not required, but as you get to a certain size for your bond anticipation note, it may make financial sense. So usually the financial advisor will do a financial analysis to see if it makes sense to have an offering document and a rating on your notes. If you have both of them, it creates greater liquidity for the underwriter to sell it in the secondary market. And usually you will get a better rate by having one. For general obligation bonds, like discussed before, the term is equal to or less than the weighted average of the life of the projects that you're financing. Typically, bonds are issued at 30 years or less. Interest rates are fixed at the time of the sale and do not change over the time. So right now we're in a very good interest rate market. So if you can permanently finance notes right now and fit it into your budget, it's a good time to do so. Principal is paid once a year and interest is paid semi-annually. And principal is amortized quickly based on New Jersey's local bond maturity schedule requirements. You need to have conforming maturity schedules, which means that the lowest principal amount in any year cannot be less than 1/2 of the largest. Bonds for municipalities are sold through a competitive sale process. So we put together an official statement that will market the bonds. A notice of sale gives the terms of the bond sales to the underwriter. And then the underwriter will come in and submit a bid by a specific time. This requires also a bond rating, and the township's bond rating since 2019 has been a AAA, the highest bond rating that is out there. And then bonds may be eligible for early prepayment. Typically, there's a call date for the bonds between 7 to 10 years out, that if the market gets better and there's lower interest rates, you could refinance for interest rate savings. The other option is also doing a lease financing. Typically, that's done for capital equipment. It's usually 10 years or less if you're financing equipment. Currently, the Monmouth County Improvement Authority, they do a biennial equipment lease financing that has a county guarantee. The county is also rated AAA by all 3 rating agencies. Typically, the township does participate in that program. There's one currently happening right now, and that provides the lowest interest rates in the market through the county because of the strength of their AAA guarantee. You can also do a lease financing with a public-private partnership. So your neighbor, the township of Middletown, they were looking to build a new municipal complex. They actually did that through a public-private partnership with Brandywine Development. They were able, through a lease financing, you can have a guaranteed maximum price contract, which turned out really well for them since they're building that facility right now, and construction prices have increased dramatically. So sometimes for a larger project, it's easier to go out and look at a lease financing because of bidding requirements. You don't have to pick the low bid contract when you're building a larger project. That's very important. There might be cost overruns. Having a guaranteed maximum price contract can be very advantageous to a municipality.
Can I make one comment about the leases? One of the advantages of taking the Monmouth County lease is the fact that for like vehicles, trucks and that, we're paying over the useful life of the vehicles. If we go out and bond them, a lot of times we're paying those bonds, 5, 6, 8 years after the vehicle's been trashed. So it kind of makes sense for vehicles to use a lease type of option.
And just giving a comparison between bonds and notes, with notes, bond anticipation notes, you're paying minimum pay down, so you're not really amortizing principal. And if you keep on rolling over notes on an annual basis, your total dollar amount of what's outstanding can ramp up very quickly. So usually municipalities look every 3 to 5 years to do to permanently finance those notes into a bond. So you have a quicker amortization. You're not getting in trouble with your debt ramping up too quickly in notes, where then you can't pay the debt service when you go to bonds. So what to consider when you issue bonds, notes, or leases: the amount to be financed, the required principal paydowns of the notes. Once you start rolling over your notes for a couple of years and you're paying principal paydowns on all the different ordinances, a lot of times it makes sense to then convert it to bond anticipation notes. So you have a scheduled maturity schedule. What is the balance in your capital improvement fund? You have to consider future capital planning. What do you have down the road? When you have more and more capital projects down the road, a lot of times it's good to permanently finance. So you know exactly what you're going to be paying on an annual basis. But it also has to fit into your budget, and you have to look at the potential tax impact of issuing bonds. Sometimes there's municipal reserves that can pay for the debt service. And then also the municipal bond market. Rates are changing on a daily basis. Currently, we're in a very good interest rate environment, both on the short term and long term. So you have to consider, if notes are, if the note market is a really good market and interest rates are low, you might want to roll over notes rather than issue bonds that have a higher interest rate. And then you have to look at what equipment or facilities that what kind of capital projects you're looking to finance.
Yeah. I'm back, and I apologize. My computer all of a sudden just blew up. But one other thing that you want to consider when you're looking at market and notes and bonds is that if you're trying to make a decision of doing notes versus bonds, the other thing you want to look at is the interest rate risk. That, if interest rates are trending higher, or that they're, probably going to trend higher, even when you're looking at that notes and bonds, you want to take a risk analysis and what happens if interest rates rise 1 point, or 2 or 3 or 5, whatever, so that and you can make a decision on whether or not going into the market, especially into a market like we're in right this minute, which is a great market, if it's worth the risk to stay in notes.
And just to talk a little bit about the market last year at the start of the pandemic, it was very strange to see, because this isn't normal, but it was difficult to get 1-year notes done, and you're paying a higher interest rate to issue notes because the investors were unsure of what the pandemic was going to do and whether you could pay at the end of the year. Because if you have a $10 million note outstanding, that matures in 1 year, and you have a $10 million liability plus the interest on that. Investors were very scared about a bullet maturity like that maturing when the pandemic was new. On the flip side, a bond transaction, those were getting done at lower interest rates because you're spreading that $10 million out over several years.
Right.
That stayed around for probably a good 6 months before lower interest rates started on the note side, on the 1-year note side. But it's always important to look at things like that.
Yeah, it just took the market a little bit to settle itself down.
Just to give you a little market update, as of the end of last week, today and tomorrow, the Federal Open Market Committee has a meeting to discuss interest rates. It's expected that interest rates will remain low for the foreseeable future. Economists are thinking probably for the next year. Right now, there's strong demand for municipal paper, whether it be 1-year notes or long-term bonds. There just is not enough supply in the market to meet up with investor demand.
Right. And that's something that's really been happening for the last 10 to 12 weeks. I mean, we have a morning call with our firm every day at 8:30 where we go over what the market's doing. And we've been hearing this same spiel now every day, that the supply's just not there. And, if you get into the marketplace, you're going to see the result of that. So U.S. Treasury yields, those are taxable yields. They've been declining over the last couple of weeks. The 5-year benchmark yield decreased 2 basis points. The 7 and 10-year notes decreased 4 basis points. And then the 30-year bond yield dropped 5 basis points. And that's all in the past week. Municipal bonds are priced off of the municipal market data, or the MMD yield curve. That yield curve takes a bunch of AAA transactions in the marketplace on a daily basis and compiles that into a yield curve. Bond transactions are priced off of that, so a spread plus over and above that yield curve. In the first 3 years, rates were unchanged last week. And 25 to 29, rates decreased 1 to 4 basis points. And 20, 30 to 51, rates dropped another 3 basis points.
When we're talking about demand for paper on a weekly basis, the Lipper Index discusses inflows into the municipal market. Last week, there was $2.46 billion of inflows, so additional money into the market. That happens, one, because of increased demand, and then two, if investors had maturities last week, so probably a 6/1 maturity date of municipal paper they're already holding, they're looking to reinvest their funds into more municipal paper.
And those declining interest rates in the municipal market, that's really been happening now slowly over the last 2 months. I mean, they are just continuing to inch by inch lower on a weekly basis.
We didn't think
saw a
that
little uptick.
rates could get lower, and they keep on happening.
No. And we did see a little uptick. Right. We did see a little uptick earlier in the year, which is typical when you're following a presidential election, but the market settled right down.
So this is just a graph from 2013 to currently of the municipal market data, the yield curve that municipal bonds are priced off of. As you can see, there was pre-pandemic in February 2020, there was an increase in rates, and it was expected that rates were going to rise over the year. Then the pandemic hit and rates dropped out. We were at historical lows on the short-term end starting in June of last year. And they've consistently remained the same since then. But you can see that the 30-year, the green line at the top, is at basically historical lows, with the 30-year being just under 2%. So we wanted to put together some of the most recent bond and note sales that have occurred in New Jersey over the last couple of weeks. On the top is the bond sales. The New Jersey Infrastructure Bank, that's a AAA transaction from the state. That was a 1.88% bond transaction. It went out to 2050. Another one to look at is Union County. They're AAA by Moody's. They received a 1.16% and went out 10 years. When we drop down, sorry, Judge.
I was just going to say, you can see the compression. You can see the compression in the rates. You know, we're talking about rates that are going out 30 years and rates that are going out 10 years. And it's, you know, there's a real compression there in interest rates across the board.
And I think too, when you look at the different rating categories, AAA is the highest, then it goes to a AA1 or a AA plus, and then a AA2, AA. Rates or spreads between credit categories have also compressed. So typically in a normal market where we have a little bit of higher interest rates, a AAA would mean a lot in the marketplace. You'll get more demand right now with a AAA rating. You'll have, we're doing a Morris County sale today, and it looks like 9 or 10 underwriters are going to bid on that transaction. That's not normal with that many underwriters fighting over the same transaction. But when you compare a AAA to a AA1 transaction now, there isn't a large difference between credits when you look at the pricing. It might be 5 basis points, 10 basis points, where in other years it would be a lot higher.
The other compression is between taxable and tax exempt. We also priced an Atlantic County transaction last week, and because it was a development project, it was taxable. And that went out 30 years, and that was just under 3%. So 30-year taxable, under 3%. It's the compression is everywhere.
And then when you look at the short term, the note sales that have been done over the last couple of weeks, on Thursday, Wayne Township, which is a AAA municipality, they sold $30 million of notes, and that was at a 0.1%. So on a short-term basis, you're practically paying no interest to borrow money.
Right.
Just to give a summary of the township's debt picture, you have some serial bonds outstanding, a couple of Monmouth County Improvement Authority capital equipment leases. And then you're also paying about $230,000 this year on note interest for your outstanding notes, which are listed below. So that gets you to $3.5 million in annual debt service for your bonds, lease, and note obligations. Your outstanding short-term debt, you have $13,299,000 outstanding, with one note maturing July 12th, and then another note maturing November 23rd. So now it's the time to look to see if we should permanently finance, the township should permanently finance some of these bond anticipation notes. So this next slide is giving a scenario. Scenario one assumes rolling over your July notes to February of 2022, and then permanently financing those notes that you would roll over, plus your November notes in November of 2021 into bonds. Like you saw before, it's a very low long-term bond market, low interest rates. So if you can fit it in your budget, it makes sense to permanently finance now because we don't know what interest rates are going to do in the future. Scenario two looks at permanently financing all of your bond anticipation notes in 2022. And we assumed a 50% increase, or 50 basis point increase in rates, just to be conservative, to look at the different scenarios. So if you permanently financed your notes in November of 2021, debt service next year would increase approximately $1 million. And then you would have a couple of years of drop off in debt service. And then we would look to potentially do another bond deal in a couple of years. We think it makes sense to permanently finance your notes right now. We know that you have an increasing pilot from Bell Labs, that it would make sense. I think it fits within your budgetary impact to issue bonds now to permanently finance rather than waiting another year or two. You're starting to increase your short-term obligations, your notes, into an area where it makes sense to permanently finance. So you have a stable schedule. You know what principal and interest you're paying on an annual year, and you're not taking market risk.
So either way, we're looking at over $1 million increase in debt service in the next couple of years. It's just a matter of timing of when we get that hit. And then the decreases, I know it's obvious, but I just want to state it for everybody. The decreases are from that initial bump. So if we finance this year, we have $1 million next year, and then it's $300,000 less than that $1 million, not where we currently are.
Right.
So then we were just taking scenario one, assuming you permanently finance this year, and adding in some future capital. We have three scenarios at $3.5 million annual in capital, 4.5 million, and 5.5 million. So what does that do as we move on to future years, assuming that you issue 3.5 million annually in capital? It doesn't affect the next couple of years, but where you start seeing some increases is in 2025 and 2026. Increases slightly in $150,000 a year until you get to 2030, when your existing debt service drops off, completely and you start replacing it with future capital. The $4.5 million scenario, same thing, the next 2 years in 2022, 23, 24, it doesn't affect your budget. And then you start increasing your budget in 2025 by about $200,000 a year. There will be a small decrease in 2023's debt service once your existing debt service drops off and you start replacing it with $4.5 million a year. And then the third scenario, assuming that you issue $5.5 million on an annual basis, the increases would be about $250,000 a year all the way out. Right now, Sharon, if you put the summary page up, the next one. Right now, when you think about it, the existing debt service of the township is just about $3.5 million this year. If you're replacing it with $3.5 million in principal, you're going to be increasing your debt service budget, whether it's 3.5 million, 4.5 million, or 5.5 million. You're only paying off 3.5 million of principal and interest, and you're replacing it with only principal that's higher than your total debt service budget. So there is going to be an increase to the township's debt service budget.
Yeah, and these scenarios are showing notes that eventually get rolled into bonds.
And these scenarios have some assumptions. I mean, these aren't guaranteed numbers. It all depends on the market and what changes. I don't know if you can go over some of the assumptions that are part of these scenarios.
Sure. So for the next couple of years, next 2 years, we were assuming note rollovers of 0.5%, then increasing to 1% and then 1.5%. We assumed doing bond financings in 2029 because you have a debt service drop off in 2030. So if you issue bonds in 2029, the first payment would be in 2030's budget. But this all depends on, what you do on an annual basis, because what your budget looks like versus what the municipal market is for short-term or long-term rates. There's several different factors that roll into it, but just looking at your debt itself, it would make sense to do another bond financing in 2029. But when you're looking at issuing $3.5 million for capital annually, when you look at this table on the left-hand side, your debt will probably be around $4.8 million to $5 million in debt service annually. Just remember, you're at 3.5 million now. So over time, it'll increase $1.3 million to that $4.8 million number. If you're looking at doing 4.5 million in capital annually, your total debt service number is going to be anywhere from 5.5 million to 6 million annually. And then at 5.5 million in capital annually, you're looking at debt service to be 6 million to 6.5 million annually. So there will be some increases in the budget depending on how much capital you're going to look at doing on an annual basis. So here we wanted to compare the township to similar municipalities within Monmouth County and then others outside of the county that are AAA rated or similar sizes.
We're very strong AA credits.
So this is sorted by the 2020 net debt percentage. And just to reiterate, the net debt percentage takes whatever your net debt is and divides it into the last 3 years of equalized valuation. So it all depends on property value. You can see the first 3 municipalities on this list has a very low debt burden. So that's one of the reasons why their debt percentages are so low. But then when you get into Middletown, West Windsor, Marlborough, Holmdel, yourself, Morristown, Wayne, Colts Neck, and Colts Neck, you're all very similar in the net debt percentage range. Anything below 1% usually is typically very good. We then took your 2020 net debt per capita. So you took your total net debt number and divided it by the population to get what the liability is to each of the residents in the township. So Holmdel Townships is $2,306 per every resident.
I mean, there are many factors that go into that AAA rating, but this is one of them. This is one of the things that they look at.
So then we wanted to look at some of the rating scorecards of what the rating agencies look at as far as debt is concerned. So there's two indices they really look at: net direct debt to full value, and then net direct debt to operating revenues. Your net direct debt to full value is 0.89%. That's in the AA category, based off of property values. Again, it's a very strong indice. Your net direct debt to operating revenue, that's only in the A category, because that basically looks at how much debt service you're paying to the total revenues in your budget. So you're paying a higher debt service annually in your budget compared to other AA or AAA municipalities across the country. In New Jersey, that's typical to have a AA direct debt to full value number. And typically in New Jersey, AAA municipalities don't actually come out to AAA municipalities on the rating scorecard. They're typically at a AA, and then they get notched up to a AAA based on their fund balance numbers, and also their wealth indices and the economy. Obviously, we have a very good job market typically in New Jersey because of the proximity to New York City and Philadelphia. And specifically right now, suburban communities in New Jersey are thriving, whereas some of the cities are not as much. People are moving out, assessed valuations are increasing in your municipality. And you have more and more development because you have the land to do so, and cities don't have that opportunity since a lot of them are built up. So we're not concerned as far as the net direct debt number is for the municipality, but we do think that it's the time to come up with a plan of what your annual capital spending is going to be. There was, in a couple of years ago, there were some higher ticket items that were paid for, that you were looking to borrow for, and that was offset by some of the pilot revenues coming online. So I think now you really need to look at your capital budget and determine what you think is the township needs to spend on an annual basis to pay for capital projects. Two of the other indices that the rating agencies look at are the fund balance as a percentage of revenue, and then the 5-year dollar change in fund balance as a percentage of revenue. They always want to see fund balance increasing, especially for the higher rated municipalities. Your township has been doing a great job with fund balance, and fund balance means, what's in your actual fund balance plus any reserves that you have on hand. And you can see from 2016 to 2020, those those categories have been increasing steadily. So that is a good thing when the rating agencies look at you.
Yeah. And especially, I think in your case, because your debt is also rising, it's really important to keep that fund balance also rising to at least to offset to some degree your additional liability.
Does anyone have any questions on the presentation?
Hey, Heather, I think it would help, because I know some towns don't really understand what the purpose of the MCI is and kind of what they do. You just touched on it, you mentioned at the beginning. Would you mind just, you or Doug, just kind of covering what the MCIA is, why they were set up, and kind of what they do, especially for towns that don't have a AAA rating? I think it would help the TC as well as the public that's listening in.
Sure. The Monmouth County Improvement Authority, and really all the improvement authorities across the state of New Jersey, and I think every county has one now with the exception of maybe 4 or 5. But they're basically put in place to offer municipalities an alternative to just doing a traditional geo-competitive bond issue. And they did that because over the years, obviously, finance has evolved and public finance has evolved. And the Improvement Authority's law is very broad. It gives them the ability to do variable rate debt, leasing, capital leasing, pooling municipalities together, all different kinds of different structures that, again, just offer an alternative. When interest rates are higher, and when interest rates aren't as compressed as they are, you'll see a real advantage at the Improvement Authority financings because the county provides their AAA guarantee to issues that are done at the Improvement Authority. So especially for towns that aren't AAA, it gives them a lower cost of money. And again, we've talked about it a couple of times in the current market where interest rates are so compressed, it's a little bit more difficult to get there, although we see it. You guys are participating in our capital lease that's going to be pricing probably in August or so. You kind of jump in every other year. The Improvement Authority does that financing every other year. And it does provide a lower cost of money because there are so many municipalities that jump in. So we go out to the market on a capital lease that's doesn't a minimum or a maximum of 10 years, minimum of 5 years. But because we go out with a bigger issue, it attracts different buyers. So we were able to still, I think, in this compressed market, to deliver a cost-effective capital lease program. So again, you guys are now AAA, and you're a strong credit. Moving forward, we will always, as part of what we do, we always look at what alternatives you have out there when you're doing a financing, the Improvement Authority being one of them. If in fact there's a point in time where we believe it's more cost effective, we'll be telling you it's more cost effective to do. I think the November issue will be difficult if you do one in November on your notes, only because, again, the compression of interest rates and the county's AAA and your AAA are kind of going to be pricing on top of one another. But we will look at it, and it may be volume that carries the day and provides just a slightly better cost of money. But that's what the Improvement Authority does. They've been around for 30 years. They've issued for every single town in the county. They've issued for most school districts in the county, and they've issued for a lot of local authorities. But they have issued for every single municipality over this last 30 years.
And I think what sets them apart from other improvement authorities over in New Jersey is that they have 2 programs that they do. One is the pooled loan program that happens every December that permanently finances bond anticipation notes or new capital. And then, like Doug said, the capital equipment lease happens every other year. There's always a schedule, so the municipalities know when they're doing their programs, and then other programs pop up here and there as there's a need, a municipality or school district comes to them. But then also, Monmouth County has 3 AAA bond ratings, the highest that you can get. Other counties have 2, but not all 3.
Monmouth County is a spectacular credit. I mean, it's just a very, very strong credit.
Well, thanks for that, Doug and Heather. Anybody in the township may have any questions for the presenters?
Can I just make one comment? We're talking about the net debt. The open space debt does not count against our net debt. That is exempt by statute. And also the swimming pool and the sewer, as long as we cover our costs, that is also exempt from the debt calculation.
Right. And you're supposed to cover your costs. I mean, it's supposed to be self-liquidating debt at the sewer.
I have a few questions, Mayor.
Sure.
Okay. So first on the MCIA, I believe they are on a schedule. Could you talk to us about how far ahead we have to inform them to be able to participate in their issuance?
It depends on the financing. As Heather was noting, this improvement authority does offer a pooled financing every December that's designed to take out municipal notes or unfunded capital ordinances. We tend to do both. That program, we start ramping that up in the fall, and we need to know whether or not there's participation by October. Because we need to go to one of the issues with an improvement authority is that you have to get approval at the local finance board, which only meets once a month. So we try to get to the October local finance board meeting, so that gives us the ability to issue in November or early December. But every once in a while we've gotten crunched and we actually do a November LFB, and then we force a quick financing late in the year. So it's a long way of saying we need to know early October whether or not you really plan to participate. The town actually has the ability to pull out, before we get a financing done. And it's never really happened, but the problem would be if you decided to pull out between October and the issue, is that you kind of screw up the whole financial model. There's cost to do a financing like that. So suddenly we're shuffling around the cost to the remaining participants, et cetera, et cetera, et cetera. And the deal just looks different than it did in October. But you do have the ability to pull out if for some reason you had to.
Well, and the Improvement Authority does a financing seminar every year, typically in February or March, that discusses the programs they're doing for the year and what the schedule is. They also send out demand surveys to the municipalities and school districts for their programs with a due date of when they need the information. And then we start modeling, having conversations. So on the capital equipment lease side, we've been working with Bill over the last couple of months on the township's demand survey. Also, the school board for Holmdel is also looking to participate as well. They typically participate for every capital equipment lease program.
The Improvement Authority will do other issues. I mean, they're just not doing the equipment and the pool at the end of the year. There are times when we'll do a pool financing in the middle of the year if demand is out there from the municipalities to take out notes for whatever reason. Last year during the pandemic, when the markets did spike, the Improvement Authority did a pooled note based on the county credit because there were some Monmouth County towns, as Heather said earlier, they're having a difficult time just getting into the marketplace to issue a note. And they had notes that were rolling over from previous years. They had to get into the marketplace. So the Improvement Authority with a county guarantee jumped in and with a much bigger issue was able to issue notes for all of the towns. That obviously we didn't have to do that this year. The market settled down, but it's just a long way of saying that the Improvement Authority kind of like fills a void wherever the void is and whatever kind of financing issue there happens to be going on.
Mayor, I have a few questions. We are right on at 10:30. Is that okay if we go past a little?
Sure.
Okay, I'll make it short. So you mentioned that our notes that are coming due this year, we couldn't participate with MCIA. Was that because we couldn't meet the October deadline last year, or was it for other reasons?
No, you could participate with the Improvement Authority, but I think with the reduced credit spreads, it may cost the township more money by going through the Improvement Authority because you have a AAA rating. If you were a AA1 municipality, AA2, it may make sense and provide additional savings. But this year, the credit spreads are very tight, and financially, it probably does not make sense for the township to.
Remember, the Improvement Authority doesn't have its own credit rating. So whenever they price bonds, they do it on the issuer's credit. So if you were in there participating in a financing in November and you're AAA, the advantage is kind of gone when we would also be using the county's AAA. And again, every once in a while, even though you're such a strong credit, we can overcome that with a size. In today's interest rate environment where everything is just so compressed, we're probably not going to see that this November.
Okay.
But we will look at it for you.
Thank you. Another question I have is the thing that I fear the most in our budget is our short-term debt compared to our long-term debt, purely because it obfuscates the true debt service cost. So a couple of questions there. Is there like a rule of thumb in terms of what would be your short-term debt percentage compared to your overall net debt that is good to have so that we are below that percentage? And also, if you could share us, you showed us the peer comparison of net debt with other municipalities. If you could also split that net debt into short-term versus long-term, it'd be good to know how much short-term debt they carry versus what we carry.
I'll start answering. I don't know if there's a true rule of thumb on how much short-term debt you should be carrying versus long-term debt. You know, when you look at the rating agencies see it as debt. You know, it's authorized. They know they have the ability to issue one way or the other. I think the rules of thumb to go by are a couple of things. One, you don't want to jump into the long-term market on an annual basis because it does cost money to do that. And, you know, so it's more likely that you gather notes for a couple of years, you make the issue large enough to attract a good set of buyers, and you get into the marketplace. And you do that when you're also looking at the market. You might want to speed that up if like I said before, if interest rates are trending up, you might not want to wait. You might want to, you know, do a more compressed schedule. You might want to wait if you're looking at your on a budgetary basis, whether or not suddenly the pay downs that are required in your outstanding notes become more costly than actually issuing the debt. If you know that you're going to take these notes long term, but suddenly you're burdened with that required 3-year principal pay downs and they become burdensome because they're large, you might want to go out earlier than later. But it's really, you want to look at a combination of your budget, what your budget can support, what your annual practices are, and what your plan is, which is why, you know, I think it's really important to take a long-term look at a plan, because then it gives you the tools to make the right decision on when you should be jumping into the marketplace. I think that the rating agencies are more impressed with towns that are taking a methodical look at a capital plan, and when the issuing is smart, you know, they know what that is, and that's kind of what they look at more than a percentage number of what, when you're issuing long or short-term debt. And I think that's a good approach.
The rating agency will also look at what your annual debt service is on your bonds, and then they will take your outstanding notes and they will amortize them. They'll assume that you're issuing now bonds and how much is your annual debt service. And they'll look at where you fit in then in their matrix, assuming that you permanently finance your notes. Because there are some municipalities that get in trouble and they continue to roll over their notes, make minimum pay downs, and then all of a sudden you're at $30 million and you can't fit $30 million of bond debt service payments in your budget.
Right.
Exactly. Thank you.
Anybody else? Any questions, guys, from TC?
I think you're just on mute.
Yeah, I have a question, Mayor. I'm sorry. I just want to thank everybody who participated in putting this presentation together. I think it was very helpful, not only for the committee, but for the public, if anybody's out there paying attention. And I definitely am in support of restructuring, refinancing the short-term obligations. I think interest rates are extremely low, as Doug and Heather pointed out, and we can't expect them to go much lower. So I would like to see us move in that direction. And the one thing I think would be helpful, and this is for Bill and Sharon, is in those charts we were looking at about the increase in debt service at the 3.5 million, 4.5 million, 5.5 million thresholds. It probably would make sense for us to see the anticipated pilot revenue increases along that same structure. Maybe a column in there. So we would actually know that if we were going to add $4.5 million in debt service, we would see some sort of increase from prior year in the pilot. I know that's available. It's probably something you can easily just slide in. Maybe our financial advisors could help with that. Thank you.
Cool. Anything else, guys, from the committee? Good. All right. Terry, we'll open up for public questions, comments, please.
There are no hands up at this time, Mayor.
Okay, that's fine. Anybody from the public, if you're on listening, I know there's some people on, you're welcome to ask any questions right now. I'll give you an opportunity to do so. If there are none, you don't have any questions because Heather and Doug did such a thorough job, then I will close the.
We put everybody to sleep.
No, it was very good. It was very great job, and for putting this presentation together. Sharon, thank you. For Bill, for all your work in this as well. Great job. I think this is good. It's great transparency for the public to see where we're at as a township, and what we're trying to do to maintain, a no increase in taxes, but be able to continue to provide the services that the residents have become accustomed to, and we need to provide the same level of service that we've always done in town. So thank you for that. With that, closed public comment. Sharon, do I need a motion or a council motion to go into exec and then close?
Yes, we had one issue that arose yesterday, committee, that we're hoping to have a very brief executive session on. It's contract negotiation regarding a shared services agreement. So if the committee is so willing, we'd recommend a motion to go into executive session. And so the public is aware there won't be any further formal action. So the committee will not come back into public session. And there's a separate Zoom link that I believe was sent out to the committee that we can log into to have this quick executive session.
Motion.
Move.
Motion second. All in favor?
Aye.
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 Everyone good? Okay.
Thank you, everyone.
Thank you.
Guys.
Thank you. Thank you very much for your presentation.
Motion to adjourn.
Thank you.
Motion to adjourn. Good.